Welcome to class number 5 of the Opus Monetae program. You're starting to build some momentum towards your financial future. In the first few classes, we learned how to measure our finances from a very high level. Beginning with this class, we're going to shift our attention to specific areas that we'll need to know going forward. You've probably heard the term cash is king. Cash is a very important asset, and managing it prudently is one of the most vital things that each of us can do. In this class, when we use the term cash, we're not only talking about paper currency, but also the money we may hold in a bank account or at other financial institutions. When we say cash, think of any money that is issued by a government. In this lesson, we're going to consider two basic questions related to cash. First, how much cash do we need at any given point in time? And second, where should we keep our cash? Let's get right into the first question. How much cash do we need to have at any given time? Well, as is the case with many concepts in personal finance, the answer is it depends. Let's assume you have recently graduated college. You began working at a great entry-level job and your earnings are more than your expenses, so you have some money left over. One of the most important things that anyone can do with their extra money is establish an emergency fund. An emergency fund is an account or multiple accounts that you can access quickly and easily in the case of an emergency. What are some examples of an emergency? Losing your job, sickness or injury to you or a loved one, or worse, a vehicle breakdown, damage to your home, loss from theft, natural disaster, etc. Now you may say, well, Rob, I don't need money for many of these because I have insurance that covers these risks. While that may be true, and we're going to cover insurance later in our program, it's also true that insurance companies may take some time to pay out a claim. Therefore, it's smart to have cash on hand in case you're in a pinch. You may already have cash saved away, but never called it an emergency fund. Or maybe you have cash saved, but don't really know how much you think you'll need. There's a range of estimates out there, and your individual circumstances will affect how much you decide to keep in an emergency fund. Many experts recommend that you keep a minimum of 3 months' worth of living expenses in this fund. What's a living expense? Well, remember those needs that we talked about in the last class? We're talking about those. A living expense is anything you need to pay for to live. Don't forget to also add the monthly payment for any debt you owe today. If I lose my job, I will have to pay for my needs and also make sure I am able to make the monthly payments on my debt. While 3 months of expenses is a common goal to save, you may want to be on the safer side. If so, you can certainly increase that amount to 6 months worth or even a year's worth of living expenses. That all depends on your preference, but an emergency fund of some amount is always a good idea. All we can do is make our best estimate. Since we don't have a crystal ball to see into the future, we won't know how much money we will actually need going forward. Not having enough in an emergency fund could leave you in a financial bind, especially if you incur unexpected expenses and have to borrow money using high interest debt from credit cards. On the other hand, having too much money in an emergency fund also might end up costing you. How? Well, for the benefit of having your money accessible and safe in cash, you may not be getting the best return on your money. We'll learn later that risk and returns are usually correlated. The key with building an emergency fund is balance, balance, balance. The right amount is something you need to decide, but I hope the 3-month to 1-year guidelines are very helpful. Okay, great, Rob. I want to set up an emergency fund covering 6 months worth of expenses. How do I calculate that? Well, remember the budget we learned how to do in the last class? Take your estimated monthly living expenses, in other words, your needs, and multiply that amount by 6. And voila, that's the estimated amount you need in an emergency fund to cover 6 months worth of living expenses. Now, if you want to add in a cushion for the wants in your budget, you can certainly do this as well. Therefore, if you lose your job and you need to lean on your emergency funds, you don't have to feel like you're living too Spartan and not at least enjoying some of your time. Again, it's all up to you. You're not going to be able to see the future, so it requires some estimating. It's important to remember that 6 months worth of expenses is going to be a significant amount of money to most people. So it's very unlikely that you will fund your entire emergency fund with a few paychecks. But that should not deter you from starting to build your emergency fund towards a targeted amount. Every time you get paid, the amount you earn should cover your expenses. All or a portion of the money left over, your net income, can be deposited into an emergency fund. When I first started working, it took me about a year to build up my emergency fund. But I put myself in a much better position to handle the financial uncertainties that could come up. And believe me, they do. Have you ever heard of Murphy's Law? This law says that anything bad that can happen will happen. Murphy definitely knows the value of having an emergency fund, and now you do too. Here are a couple good reminders related to emergency funds. If you need to use any of the funds, don't forget to replenish them in the future. After all, you could have more than one emergency, especially over a lifetime. Also, it's important that you revisit your emergency fund at least annually, or more often if you think you need to. Living expenses can rise just because of inflation. We'll talk more about inflation in another lesson. If your budgeted expenses do go up, make sure your emergency fund also rises to cover these higher amounts. Another important question you might have is, what type of account can I use for the emergency fund? This is another area that you will need to decide based on your own circumstances. As a general rule, an emergency fund should be held in an account that's easily accessible, has an extremely low risk of loss, and can be immediately used to pay for expenses. If you're dealing with an emergency, the last thing you want to have to do is wait to access your money when you need it. You also don't want to have this money sitting in a risky asset or investment that may lose money over time. Imagine if you put $20,000 of emergency fund money into a risky asset. Then, let's assume this asset's value declines substantially to say $10,000. If you need to access your emergency fund, you will be $10,000 short of what you estimated you would need. To this end, many people keep their emergency funds in a separate account at an FDIC-insured bank or an NCUA-insured credit union. We'll discuss how deposit insurance programs work in the next class. Banks and credit unions offer a variety of products such as checking accounts, savings accounts, money market deposit accounts, and certificates of deposit, or CDs. Many also offer savings accounts that pay a higher interest rate. These are referred to as high-yield savings accounts. Checking accounts tend to be the most accessible of these options, as funds can normally be obtained via a variety of withdrawal methods. In person, through an ATM using a debit card, by writing a check, or through online payment methods, such as ACH. Checking accounts typically pay an extremely low interest rate to depositors, if they pay one at all. Savings accounts operate very similar to checking accounts, except you cannot write checks on a savings account. These accounts typically offer a higher interest rate than checking accounts, but not as competitive as other types of bank accounts. Money market deposit accounts typically operate very similarly to checking accounts, except there historically were limits placed on how often certain withdrawal transactions could occur. This transaction limit was known as the Regulation D limit, issued by the Federal Reserve, and generally restricted account holders from doing specific types of transactions more than 6 times a month. It's important to note that this limit was suspended indefinitely in April 2020 during the COVID-19 pandemic. So account holders don't have to worry about this limit right now. Money market deposit accounts typically offer a higher interest rate than traditional checking accounts and savings accounts, but not as competitive as high-yield savings accounts. High-yield savings accounts is a term for savings accounts that offer a much higher interest rate than traditional savings accounts and even money market deposit accounts. They operate very similarly to traditional savings accounts. Certificates of deposit, or CDs, can offer the highest rates discussed here, but there are some caveats that come with CDs. A CD is considered a time deposit, meaning when you buy a CD from a bank, you are committing to leave your deposit untouched for a period of time. CDs may generally range from terms of just a few weeks all the way up to 10 years. Restrictions on early withdrawal normally apply. For example, you could be charged a penalty for early withdrawal and also have to forfeit interest earned. Typically, most people use a high-yield savings account for their entire emergency fund. This account allows for easy access to the money, is considered to be very safe, and can offer a very good interest rate. Some folks might choose to keep part of their emergency fund in short-term CDs. The theory here is that if you have an emergency, you probably won't need the entire amount in the first month. For these people, they may keep funds that they think they will need earlier in a high-yield savings account that's accessible immediately, and keep the rest of their money in a short-term CD that may earn a higher interest rate than the high-yield savings account would. There are other alternatives that might be considered, like using short-term treasury bills, which we will cover later when we discuss debt investments. The type of account or accounts you utilize is an often debated topic by financial professionals. To be clear, only you can decide what is the right type of account or accounts for you to use. The key here is to understand the benefits and drawbacks of each one. One of the most important things to remember about an emergency fund is that it shouldn't be used for anything other than an emergency. Sounds like common sense, right? But you'd be surprised. It's not smart to take measurable risks with it. The fund is not there to cover your day-to-day bills. It's strictly for an emergency. Don't ever forget that. You can certainly have other accounts for your day-to-day spending or savings for things other than an emergency. In our next class, we're going to discuss several key points on managing your banking relationships and some things to keep an eye out for. Don't miss it because it's extremely important and goes in tandem with this lesson. In the meantime, I have one homework assignment for you. Calculate how much you need in your emergency fund. Set a plan to fund it. And also put down a reminder to revisit your emergency fund at least once a year. If you have any questions at all, please contact me at opusmonetayquestions@gmail.com or comment below, and I will try my best to get back to you as soon as I can. Thanks for watching. We rely heavily on recommendations. Please follow us on Instagram, subscribe to us, and like this video on YouTube, and share our program with your friends and family. See you all in class number 6. Peace!